All right, welcome everyone to today's compliance webinar. I'm Jeremy Yohe, ALTA's Vice President of Communications, and today we've got a wonderful webinar lined up to help you understand the latest claims trends and look at how the COVID-19 crisis could affect claims going forward into the future. Before starting, I just need to touch on a few housekeeping items. Number one question we get a lot is if audio is choppy, you might have a weak internet connection, so you may want to select the telephone option. Another question we get is, how do I get a copy of the presentation? You can download a copy from the handouts section. There's a PDF uploaded there. And then the third common question we get is the presentation being recorded? So, and the answer is yes. You'll get an email with a link to the recording tomorrow. And you can always go to ALTA's website to access our archive of all of our previous webinars, and that's at alta.org/webinars. All participant lines are muted for today's presentation. At the end of the presentation, we will have a little interaction. So we'll have some poll questions just to make sure everyone's paying attention out there. So no multitasking. And I do need to extend a thank you to Old Republic National Title Insurance Company for sponsoring our compliance webinars this year. And then on our next slide is our legal disclaimer. Please know that this presentation content is not a substitute for legal advice, and this material is for information and educational purposes. And with that out of the way, let me briefly introduce today's speaker, and then we'll get to the presentation. Joining us today is Leonard Prescott. Len is Vice President and Regional Underwriting Director for First American Title Insurance Company. And in this role, he provides a myriad of underwriting guidance and support for agents. And with that, Len, I will step to the side and let you get to this cool content on claims.
Terrific. And thank you, Jeremy, and welcome, and thank you all for taking your time to be with us today and to talk about some current, very crucial issues for our industry. It's amazing how much our world has changed in a few months, isn't it? Maybe we've started to get used to it, but just recently I had no idea about such terms as shelter in place, social distancing, PPP, paycheck protection plans. Ordinarily, real estate and title professionals are pretty slow to embrace change, but not this time. During this age of COVID-19, I've never been so proud to be part of our industry. We've quickly demonstrated support for each worker, not just for the work. And we've cared about the physical and emotional health of our teams, as we've probably worked longer hours during this pandemic than ever. No COVID vacation for any of us. We've got a newfound acceptance and respect for working remotely, and with new rules of the game, social distancing, our teams have remained connected and engaged during this time. And as an industry, we've been professional, dedicated, and I think incredible. So we've got the people, we've got the strategies to move through this crisis and succeed. And today, we're going to talk about some of the current trends that need to be part of that strategy, the plan that we would have to continue to change and adapt as we've done so well over the last couple months. So we're going to talk today about a general overview of the economic and real estate cycles and their relationship to claims. As much as I'd like to control this as an underwriter, there is a cyclicality to real estate. There is, in the title industry as a whole, a certain sensitivity to microeconomic trends, and it's important for us to learn from these trends and these issues and improve as we go along. We're going to then go to the top 10 claims trends to look out for during our current time. I'm going to lay these out in a fun top 10 list. But don't think that they're necessarily prioritized in a way that you should only figure on emphasizing the number one title claim trend and not the 10. If any one of these things happens to any of us, it's material and big. So pay attention to all 10. It's mostly for fun that we take that format. I'm going to then go into the 5 key steps you need to know, and your team, your company, your operations need to be taking now to counter these claims trends and to stay in business. We've already done so much during COVID-19, and now is the time where we've got to be just as vigilant. On these 5 key steps, they're so important that every person, every principal, every employee, from president to the receptionist, needs to be aware of these steps and making sure that you're taking these together. So before I get into the overview on the economics and the substance, I'd like to share with you what to me have been some of the more iconic images of this COVID pandemic. You first see an image of a COVID particle. I'm sure this is something that none of us needed to see or wanted to see, but now it's everywhere. You know, I thought about telling you all a joke about this germ, but I don't want to spread it. And in fact, only jokes allowed right now are inside jokes anyway. Here's another iconic image of the pandemic, the Corona beard. This is yours truly with my version of the Corona beard. I've got to say it came in a little better than I thought it would, but still not good enough for my wife. So it's gone already. Another iconic aspect I wanted to share with you, how about the messages of support and communication everybody's seen in the windows? This might be my favorite. Uninstall 2020, it's got a virus. And perhaps the biggest one of all, the answer to the mystery of what would it take to get the Xbox video controller out of my 9-year-old son's hands. Here we go. This is a picture I took of my son, Oliver. We live in Miami. This may have happened to others of you. I did not anticipate the run on toilet paper from the COVID virus. I didn't put 2 and 2 together. One of our underwriters that works with me up in Tallahassee actually sent this to us via UPS. Thanks again, John. Well, I could keep going and show you more images, tell you more jokes. For us dads who joke, this is a pandemic, but I know you want to get into the substance of our presentation, and this is really important for us. Let's start by putting our real estate and economic cycle into context. On this slide, I'm showing you for the entire U.S. title insurance industry, the 2017 full year results put forward by the National Association of Insurance Commissioners. Before you say, Len, why are you showing me 2017 when we're in 2020? I'll tell you, don't worry. I'm going to show you the most recent slide in a moment, but I do love this particular slide. I've kept it from prior presentations going back as far as 2018, because look how it shows us 5 straight years in which our industry as a whole, this isn't one title company or agent, our entire industry experienced losses during the Great Recession and the mortgage meltdown, 2007 through 2011. Now, recognize that those losses through 2011 were really for the infamous years of 2005 to 2007. This is because in claims, you have concepts of a lag and a tail. A lag is the delay in time from the time you close on a certain transaction and a claim is actually filed. And then the tail is the time from when the claim is filed to when it's actually resolved and the loss is incurred. So you are going to have losses in later years for policies and transactions that were in prior years. If you think in terms of a bell curve, most claims are going to be in that bell curve between about 2.5 years after closing, all the way to 7.5 years after closing. What this chart shows us is that the volume and the timing of title insurance claims are subject to cyclical influences. Title policies issued to lenders constitute a large portion of our volume. So we're subject to how the lenders are doing, their underwriting, their market. Even if underlying defects exist and there could be a claim, if an insured doesn't realize an actual loss because of a steady increase in collateral, then there is no loss. On the other hand, when the economic cycle turns, when the real estate market suffers, and you've got lower valuations, well, then there's a higher likelihood based on loan to values and defaults and foreclosures, all of these different things happening. The good news is that our real estate and mortgage markets did emerge wiser and stronger from the Great Recession. And here is that promised most recent chart. Now we're seeing 9 straight years in which our industry as a whole experienced year-over-year decreases in claim losses. And 2019 was a record in profitability and in net losses as an industry, being sub 4% on our net loss ratio. Now, what happens next with the COVID-caused recession? Well, we need to prepare, but there are a lot of very good reasons for optimism. As an industry, we are confronting the current economic recession with a position of strength. The recent year lender underwriting does not resemble 2004 to 2007 with the subprime, the no income verifications, the no money down, the homes loans in excess of the property values. And our own title industry and our underwriters and our operations are better and wiser too. We'll talk a lot about that throughout this presentation. So I'm pretty confident we're going to emerge from this recession stronger and wiser from this crisis once again. But let's look at some of the trends and the strategy in order for us to do just that. So the top 10 claim trends to look out for during the recession. I'm going to list them out, and then we'll talk a little bit more about them in greater detail. Let's see how many you anticipate that make our list. Number 10, defalcations. I'm sorry we have to talk about this one, but there are reasons we're going to discuss why defalcations are increasing right now. Bankruptcy and other litigation risks. I think bankruptcy speaks for itself. Some small businesses, some very large ones in certain industries that have been particularly affected by the disruption and the lockdowns have already been declaring bankruptcy. Other litigation risks, though, I want to go into a little bit more detail. I'm going to discuss with you both coverage risk invoked by your title policies and suing you, the litigation risks that you've got outside of our policies. Number 8, alternative purchaser or lender schemes. What is old is new again is going to be a theme of this presentation. We've got an interesting market right now with low interest rates, a lot of money out there. You would think that there would be significant access to lending, and yet in many ways we have a very tight lending and financing cycle at the moment. That has opened up opportunities for alternative purchasers, alternative lenders, and these pose certain risks that we've got to be aware of. We'll talk about it. Foreclosure fraud. Now, this hasn't happened yet, but we know why. There are significant federal and state executive ordered moratoriums on foreclosures, on evictions, but what happens when the moratoriums are up? We've got to be ready. Search and exam errors. These are always on a claims list. About a quarter of title losses on average come from this category in any given year. But now recognize that we've got new gap concerns to our searches, as well as perhaps physical and even technology access issues to our recorders' offices and the official records that are presented by COVID-19. Even if you have access during your search and exam to the records, if you're experiencing those records through a new format that is unfamiliar to you, there's an opportunity for more search and exam errors, more items that are crucial to the chain of title and to the insurability to be missed. Now we get into the top 5. Mechanics liens may be the easiest to link and connect the dots to macroeconomic cycles. Indeed, it was the #1 title claim in 2008 during the last Great Recession. We have to be aware of mechanics liens and the risks that the current COVID situation presents, and we'll talk about it. Lack of authority, capacity, and the financial abuse of the elderly. That's a mouthful. This is a huge category and would easily be further up, even though it's at #4 out of 10, it would be further up the line, only there's already a significant overlap with what I've identified as the trend #2. Wire fraud. Not all businesses have been hurt during this COVID-19 situation. If you've invested in Amazon, you know what I'm talking about. Well, guess what? Cyber criminals are booming as well. And they are taking advantage of more and more of the electronic commerce, communications, the kinds of things that we are trying to do to continue our business and protect our customers are at risk. Mortgage fraud. This is the one I was talking about on the lack of authority, the capacity, and financial abuse. Quite a bit of overlap between lack of authority or no authority and capacity and the mortgage frauds that we're going to see. Fraudsters are emboldened right now with the current COVID-19 regime. We are targets, they are sophisticated, they know our business, they know our gap, they know our vulnerabilities, and they know that COVID-19, unless we're more vigilant than ever, have just exacerbated our vulnerabilities. Mortgage fraud is huge. And the #1 trend that I need everybody to be watching out for during COVID-19, the closing process, that liability. The good news here is perhaps more than any of these others, you as title issuing agents are most in control over preventing this liability. And knowledge is power. We'll talk about it. How'd you do? Got 10. Wish this was interactive. How'd you do, Jeremy? Did you know all these?
I knew several. It does, like you said, what's old is new again. You know, even the criminals that kind of tricks involved, they kind of have the same pattern.
Okay. Let's start with defalcations. This is a sad topic, but a necessary one. We're so used to fraudsters and cyber criminals trying to steal from us that we sometimes don't see that maybe there's someone close to us, a trusted partner, an employee, even a family member that may be the source of the theft. And unfortunately, now is the time that risk is going to come out. Business interruptions like we've got with COVID-19 right now bring existing defalcations to light. This is because when someone's playing the float and cooking the books in their escrow or trust account, keeping a defalcation under wraps depends on both a steady flow of new funds into the escrow or trust account and frankly, never taking a vacation. The people that are perpetrating these defalcations quite often, the last thing they would want is to have someone else involved with the business process or their responsibilities. And it's a disaster when the volume dries up. Unfortunately, the risk is now also not only that existing defalcations, maybe things that have been going on for a little while, come to light, but we are at a high risk of new defalcations. We all know that our real estate transactions typically involve hundreds of thousands of dollars in deposits and loan proceeds. Even a very small title agency can have millions of dollars flowing through their escrow or trust accounts at any given time. Because of that, the temptation to dip into these funds can be irresistible. Sometimes a title agent doesn't even do it intentionally. It might be a negligent defalcation as a result of not being able to manage proper accounting protocols. Defalcations usually don't start with an intent to steal $1 million. They start small, and the perpetrator is desperate, and it usually intends to return the money. It's just that there's a slippery slope when they're not detected. Our current crisis we've got right now, you've got health issues, you've got investment losses, you've got family, you've got other businesses. You might think, well, my employees are fully paid and as busy as ever. We've got record volume. But do you really know what is going on with their family, with their investments, with their other businesses that occur. Another risk in the defalcation that we may be coming and vulnerable to now is the pressure from important business sources, developers, mortgage brokers, others that put pressure on some of our employees to move escrow or trust funds improperly, to use the escrow as their piggy bank. After all, they're in a cash crunch as well, and they need you to make this happen so that there's more business together going forward. You've got to be vigilant and aware of this and prevent it. The good news is defalcations have been consistently reducing in risk. Alta's got their best practices. We've got more and more electronic policy and premium remittances protocols, frequent auditing and oversight. The electronic changes have all contributed to minimizing the impact of defalcations nationally. But now is the time to be vigilant, and an ounce of prevention on this is going to be worth a pound of cure. Bankruptcy and other litigation risk. Number one, I want to talk about, let's avoid Abengoa and look out for but-for claims. Is everyone familiar with Abengoa? It was a radius report, property information report, ownership and encumbrance, these kinds of non-title product. It was a radius report for an ethanol plant that was going to be built in Kansas. A few owners were missed, and Abengoa Energy sued and won in tort, far more than anybody expected from a property information report. The verdict, which went all the way to the Kansas Supreme Court, in excess of $48 million. This was a wake-up call for the industry, and we are still seeing a rise in what I call the but-for claims. I wouldn't have bought or I wouldn't have lent but for this or that, either this action that the title agent took or the omission. There was no exception that I saw. I didn't know about this, even though it's not appropriate as an exception. Suing in tort instead of under the policy contract creates no clear limitation in damages and liability. Abengoa liability has become a war cry for our industry as we try to mitigate this, and we'll talk about it. Anticipate bankruptcy court actions. Again, I don't think this needs to be discussed too much, but be aware. If we all know certain transactions are bankruptcy remote, we can be very comfortable. Others, you've got to be thoughtful and careful, deliberate in recognizing that bankruptcy court action is going to be more prevalent after this disruption. We've got to think about preference and clawback and lien stripping for technical defects. These will be back again after a few years of not seeing much of it. And very importantly, do not insure over pending litigation, even when it seems certain. Let me give you an example on that. We had an assemblage of property being purchased with some of the parcels apparently having the involvement of a real estate broker and other parcels with no involvement of that broker. The broker claimed to have a partnership interest, even in the parcels that they had no involvement with, and to have an option to purchase some of the parcels. Apparently, the claims and the complaint was studied very heavily. None of it was in writing. At the trial court level, they appointed a magistrate who reviewed, listened, and ordered that there was a violation of the statute of frauds, that there was no interest, there was no option to purchase. None of this was in writing, none of it was effective. An appeals court in this particular jurisdiction will almost never overturn a confirmed magistrate order. And yet, you can guess what happened. It ain't over till it's over. The fact is that even where you think, boy, this is a certainty, litigation outcome insurance is not an appropriate risk for title insurance. Just like suing in tort and being concerned about what the liability is, here, the appeal overruled that magistrate's order, sent it all back, and what was thought maybe to be a $365,000 a liability on the basis of this purchase option, now all of a sudden it's multi-million potential loss. Taking on this kind of risk is not appropriate. Not only is it not appropriate from a liability standpoint, but you very well could be running afoul of regulatory concerns, violation of our monoline statute, all kinds of different things. Alternative purchaser and lender schemes. Have you seen a note or a mortgage like this one? Maybe you have seen it. Pay to the order of anybody as agent for the individual participants on Exhibit A. By the way, Exhibit A is going to have hundreds of different parties and names. We've seen these. Alternative financing is becoming more common. As we've talked about, the traditional commercial lenders are tightening up their underwriting requirements even as interest rates are low. Borrowers are in need and seeking sources of funds. And we're seeing a greater number of transactions, whether they're involving EB5 lending, crowdfunding. There are at least 3 areas of risk that I want to highlight to all of you in these alternative purchaser and lender schemes. The first one is there's always the risk that these transactions may be structured in a way that securities laws are implicated. Under our federal law, the definition of a security or an investment is expansive and can include common real estate documentation, could include promissory notes, ownership interests in an artificial person or a legal entity. Given the broad definition of security, it is easy to see how a transaction involving multiple lenders, multiple promissory notes, multiple beneficiaries could fall within the definition of a security. You do not want to be alleged as aiding and abetting a securities violation. The second risk with these alternative financing relationships is even if it's not a security violation, the lenders or the purchasers, the investors, they're not sophisticated participants. They don't have the experience to properly underwrite large commercial deals that are typically the subject of these alternative purchaser and lender schemes. We don't have the benefit of that good underwriting. And worse, if something goes wrong, how sympathetic is a judge going to be to these arguments that do justice for the little guy? The third risk involved in these alternative purchaser and lender schemes is simply fraud. Without proper oversight over where the money is going, there's a real danger that funds are going to be diverted to unintended uses, that there isn't proper agency involved. And these schemes are not limited to just the lending world. We're also seeing them appearing in ownership interests. Everything old is new again. We've seen exotic business entities today that re-raise questions about title vesting that were seen decades ago. Some of you may have been in business long enough to remember dealing with these kinds of structures before the Uniform Partnership Laws came into effect across the United States, and grappling with issues of aggregate theory versus entity theory, and whether these structures are upheld, or if in fact, with the fine distinctions of these things and sympathetic plaintiffs, that a judge would look through the structure to find that in fact it's not owned by the entity, but instead by the individual investors. And watch out for the authority issues, the fraud in the agency or the corporate relationship. These are issues and structures that you should be getting your underwriters and local experts involved. I mentioned that we haven't seen an uptick in this one yet, foreclosure fraud. As part of the $2 trillion coronavirus aid package, the CARES Act, and many state executive orders, there has been some relief and an unprecedented moratorium on foreclosures and evictions. You've seen the statistics just like I have. A recent CNBC article on their website today said maybe as much as 30% of homeowners are late are not making their payments. They're not current on their payments for March, April, May. A third of them, 30%. What happens when these moratoriums expire? Does anybody know? Is there any consistency? Do the participants that are benefiting from the moratoriums, do they get new loans? Is there forgiveness? Are there modifications? Or are there defaults? If it's defaults, be ready for a whole different seminar just on this one topic. Pay attention, study the foreclosure scams on this list, on this slide, and this will be moving up our list very quickly.
Hey, Len, this is Jeremy.
Yep.
FHFA and FHA just today extended their the moratorium on foreclosures and evictions. And I had a quick question for you. So if a title agent's doing a search and there was a homeowner who'd been approved for forbearance, how are they going to find notice about this?
Well, that's what's interesting. When I say there's no consistency, we have some lenders that are asking to record mortgage modifications to evidence the forbearance and change in terms. But more often than not, the vast majority of these things are either off record or just by statute or executive order, and there's no documentation at all.
Okay.
We're going to talk about the forbearance, not just in the foreclosure scenario, which we haven't really grappled with yet, but I've got it on everybody's radar with this slide. But I'm going to talk about another aspect to the forbearance that's complicating things when we get to the closing table risks, because it's already affecting payoffs of the mortgages. And that's fascinating, and everybody needs to know about it. So search and exam errors. I've talked about how this is always high on the list, quarter of all the claims. We're talking about missed ownership interest, missed mortgages, fraudulent mortgages that really should have been caught with a proper examination. Missed restrictions that prevent an intended use. These are material losses year after year after year. And now we're confronted with potential access issues, some more difficulty, searchers and examiners that are using new or unfamiliar methods to search and examine. Will they miss the liens? These things that are missed just from errors in a matter of our ordinary business. Will it increase? And the gap that we've all got. Mechanics liens, there's a nice picture of our happy contractors. But I don't mind sharing with all of you, I am actually one of the lucky participants who got approval and started renovating our own house in late February. And so I'm dealing with a construction loan and a major construction through this COVID site myself. And so this is a more accurate picture of a mechanic lien situation. It's the easiest one to connect the dots on. The good news is, as I've mentioned, we've learned a lot, just like so many ways, we've learned a lot since 2007. Folks today are now better trained to review construction loan agreements, the construction contracts, understand the construction budgets. They're determining the overall project viability and reverse engineering the risk on this. Is there enough money to complete the project? Are there adequate lender controls on disbursements? Are tenants or out sales already signed up? Do we have an indemnitor with proper financial backing to consider indemnity if necessary? And oftentimes now that indemnity is coming from a guarantor or a different entity than the borrower themselves. It is a different world today in mechanics lien underwriting than it was in 2007 and 2008. The industry is also moving towards a more controlled form of incremental coverage. Make sure you're familiar with the Alta 32 and the 33 endorsement series, the way to limit our exposure at any given time in the construction process. When you use this incremental coverage, you're typically performing monthly date downs to the title. This is crucial because by reviewing the title and collecting lien waivers, you're in a position to know almost immediately if there's a contractor or a sub or supplier that's not being paid. and intervene much sooner in the process in order to minimize the exposure. But the new trend, and one of the things I want all of you to be watching for, is make sure you know your deal on your transactions. Watch for essentially construction loans that are disguised as mere financing without disclosure of any inchoate mechanics lien risk or otherwise. Know a little bit about the transaction and the property and the existing improvements on it, and make sure you're uncovering when there's mechanics lien risk and a construction loan is what you're dealing with rather than a mere refinance. Lack of authority, capacity, I mentioned this is a huge one. Obviously, lack of authority is when any party signs an instrument like a deed or a lease or a mortgage, and they're not authorized to act on behalf of an entity or a person. They're just simply incompetent to act in that way. The problem is this leads to complete failures of title and invalidated mortgages. The way to fix this, of course, is recognizing and reviewing proper authority and how to spot capacity issues. But I'd like to highlight this risk, particularly as it relates to the elderly. As our population continues to age, we're realizing that we must be vigilant, especially in the context of real estate transactions. Real estate is the prime source of the targeted funds for fraudsters. Authority and capacity in the real estate transactions has to be carefully considered every time to prevent and detect and respond to a very rising financial abuse of elders and vulnerable adults. And for obvious reasons, COVID-19, with the lockdown of nursing homes, with elderly as scared and vulnerable class of people worried about COVID-19 and exposure and contact with others, this situation of risk for financial abuse of the elderly is perhaps more significant than ever before. Think about the caregivers, the family member, the religious advisor, somebody that is in a position of trust and power with an elderly person that is in lockdown and isolation. And make sure you're spotting the issues. The best tip I can tell you on that is bad feelings, your gut instinct should not be ignored. Agents have significant risk with elder abuse. You could be complicit or negligent. At least those allegations will be made. Breach of contractual duties, even if you were to win against these kinds of complaints, your name's been dragged through the mud, and you're got the cost of defenses. Alto's mottos: we lead, we deliver, we protect. This is one of the most significant areas that all of us can really protect that we've got. When we talk about powers of attorney, I go straight into that from the capacity and issues. It's because anytime a power of attorney is requested to be used, and right now you've got them in spades, don't you? Nobody's coming in person, so everybody's bringing powers of attorney for the elderly that are unavailable. But anytime you have a POA, it's got to raise a red flag, and you've got to go carefully and thoughtfully, not because the POA is bad or fraudulent. In fact, most of the time, a POA is valid, but the fraud is that the transaction isn't with the intent or even the knowledge of the principal, and that's really a challenge. Therefore, you've got to take precautions when you're dealing with powers of attorney and ask questions. Why can't the signatory principal be at the closing? Is there any alternative that we can do? Maybe a mobile closer, or a drive-through closer, or a courtesy closing. Whatever can be done, use of the power of attorney should be pretty much the last option. And when you're using that power of attorney, make sure you're scrutinizing it. Who prepared the POA? Who checked for the capacity and abusive power issues? Who spoke with the principal to make sure that they know of the transaction that you're now involved with? and then it's truly for their benefit and with their intent. Lack of authority doesn't just have to be for individuals or the elderly. We've got big issues with entity slamming. You've all talked about how you've got these opaque entities, and in many jurisdictions, it's very difficult to figure out the actual owner of a given entity. You've also got, you know, a new twist in that. Here I'm showing you something called the terrible typo, because we've started to see not just someone hijacking an existing company, but sophisticated fraudsters that actually create new companies with confusingly similar names. Here, ABC Service Groups versus ABC Services Group. This was an actual claim where they intended for someone to just not notice or assume it's a typo and not something real. So this wasn't a hijack. This was a whole different company with legitimate formation issues. You know, the fact is that not too long ago, it was a challenge to create corporate authority documentation. You had to have a certain expertise and level of sophistication. In today's world, anyone with a computer or a smartphone, you go on Google and you've got corporate authority documentation in a matter of minutes. It's a different world altogether. So you've got to be vigilant. You've got to ask questions. Was the ownership of the entity recently changed? Were the signers recently changed in the authority documents, or was there a recent modification or amendment? Is there any inconsistency in the signing authorities between documents that are filed with the Secretary of State? Any off-record documents that have been presented to you? What about previous of-record documentation? Can you compare the signatures and the signing authority and the parties involved? Were the closing documents executed outside of your control? All of these are important questions. All of these are important for you to be vigilant. Wire fraud. With millions of Americans working remotely since the beginning of March, and the outbreak of COVID-19, the FBI is telling us business email schemes have become an even bigger threat. As educated as we are as an industry, we are at a larger risk because of folks working from home and out of their normal situation. Can you imagine how much at risk our customers are? Let's look at what the FBI is telling us. This is an increase. I love this chart because it's just showing 2015 to 2019. Look at the increase in the amount of complaints that went to the FBI's IC3 state. Look at the dollar amounts, tripling, more than tripling in value from 2015 to 2019. $10 billion in total losses in just a couple years based on these kinds of frauds. And specifically to our industry and wire fraud, confirmed real estate losses. They started confirming the real estate losses and breaking it out in 2018 for the first time. 150 million in the first year of 2018. In 2019, it grew to 221 million. It is likely that it will grow again in 2020. And these numbers, they're low. There's non-reporting bias because of concern about reputational damage. And there's a difference between losses and the FBI's confirmed real estate losses. So we've got, with coronavirus, as we all know, buyers, sellers, real estate agents, lenders, everybody forced to do business online. And you've then got recent emergency powers, states and jurisdictions that now allow parts of our complicated real estate transactions and settlement to be conducted remotely. Buyers and borrowers can, are of particular susceptibility to these scams because even if they're confident with tech, and by the way, they're not, they infrequently navigate the emotional and sometimes frantic process of real estate. They're at risk without the tech involved. And so this involvement of digital transactions has created in many ways an emboldened and easier path for scammers and hackers and criminals. To illustrate this point, I want you to imagine this email going out to one of your customers. I'm going to read you what this might say. Due to the ongoing and quickly changing circumstances surrounding the coronavirus, we need to let you know that our office might temporarily be closed to public visitation. And due to this unforeseen circumstance, please be advised that our escrow account is currently undergoing an audit and cannot receive your closing funds at this time. That email that goes out to your customer or potential customer has new wire instructions for the escrow or trust account that can receive funds because it's not under the fake ongoing audit. Are your potential customers, are they prepared to withstand that kind of an email, that kind of targeted spear phishing? Are we doing enough to educate all of our customers? I don't know if we can ever do enough. Mortgage fraud, the number 2 issue. You've got forgery and ID theft, just like business email compromise and wire fraud. The success of all of those efforts is on the rise during the pandemic. You've got quitclaim deeds. They may be the easiest of the forged documents to recognize. There's going to be defects in them, no consideration, recorded in the gap or recent transactions. We're trained to notice the quitclaim deeds. They're going to be forged in mostly free and clear ownership transactions, or as we go in, if it turns out we do have a significant foreclosure market once again, they'll be forged once again in the REO context. We're also seeing forged dismissal of litigation. Fraudsters are emboldened. They know that access to the courts and everything is disrupted, and there's a lot that needs to be improved as far as disclosure and transparency. We are seeing not a forged quitclaim in the gap or a forged release or satisfaction of a mortgage, as you might expect, but actual dismissals of litigation that are forged and fake. Make sure that when you see dismissals of litigation, you're double checking with the docket. You're checking these things with suspicion if they're recent, that they might be forged as well. Improper notarization and witnessing. This became more difficult with RON and RIN, as we all know in this new electronic world, and I'll talk more about it. There are no standards. There are no cases. We're flying and doing the best we can with all the information we have to protect all the stakeholders involved, and it's a risk. This is an actual notarized signature in one of our claims files. It's my favorite signature ever. It was notarized. I've also seen insured transactions with notarizations from dead people during my career. You cannot trust. The notarizations, of course, are improper and fraudulent as well. We've got to be vigilant. Will they use RON or RIN or these new technologies to increase? Will it just be the same? We've got to keep vigilant no matter what the form of the notarization and the technology and what we're involved with. Loan slamming, this is a big one. Savvy fraudsters have known for years that there's a gap between what's known and shown in the public records and the timing of your closing or a disbursement. Maybe the fraudster is the owner of the property. Maybe that fraudster is an imposter. They've known about the gaps. Well, now these sophisticated fraudsters know that the gaps are greater. They are more emboldened. They believe that they're going to be able to shotgun or slam these loans and take out multiple loans from different title companies, or even, amazingly, because some fraudsters, as sophisticated as they are in some sense, are dumb in another, multiple orders with the same title company. We should be able to catch that. Identity theft is through the roof. Some of the other mortgage frauds you're going to see, the silent second, we call that. This is, we've got the tightening of the lender market as we talk about. So you're going to see real estate transactions where the buyers don't have the necessary down payment, the necessary money that is required. And so they're going to get that down payment from the seller or a third party. They usually take back a mortgage, but that mortgage is not disclosed to the purchase money lender. Uh-oh. Hope you're thinking, well, that could be a problem. That could be a but-for litigation suit against me as the settlement agent if I had reason to know about this and didn't stop it and force disclosure. The buyer's lender thinks the buyer is coming and bringing their own funds for the down payment and has required a certain down payment for a reason. The second mortgage is usually either not recorded or maybe recorded several weeks after the transaction in order to hide that information. So be wary of this. These schemes and these questions of the down payment of the money are significant. You've got to stop and force disclosure if you know or have reason to know about this. Another one that you'll see is illegal flipping. Now, not all flipping transactions are illegal. It's absolutely true. But statistics tell us that around 49% of mortgage fraud involves an aspect of flipping. That's a large enough statistic that we've got to consider just a flip, even if it turns out to be all on above board, to be a high risk or a situation that requires scrutiny. The biggest red flag, the one that's going to tell you the difference between this being an okay flip versus one that's not, is the falsified appraisal. You've got to pay attention to the appraisals, do your own due diligence to see if it's reasonable, and or if you have reason or should have known that it was falsified. Pay attention to properties that are purchased above market value, especially if they're distressed, as we might see, and the usual stuff, the straw buyers, the kickbacks, scrutinize payments in your closing. Where are they going? How much and why? The opposite of the flip is the flop. Like foreclosure fraud, we'll see schemes like this. They're going to lower the price. They're going to hide the fact that there's already an existing contract for a closer to fair value transaction. Be aware and don't allow yourself to be accused of being an accomplice to facilitating this kind of fraud if you know or should have known. Similar to the flop scheme is just the straight out short sale fraud. The FBI is telling us that it's this area of fraud that they believe is going to be the next wave of mortgage fraud prosecutions in the U.S. A misrepresentation, it could be the non-disclosure of related parties, the value of the property, the terms of the transaction, third-party payments, payments to subordinate lien holders, disclosure. And now for the big one, the one you must have control over. You're our last line of defense. By the way, for this slide, I had a picture of a closer's desk stacked full of papers and paperwork. Then I changed it to a Rube Goldberg machine because I recognize and have so much respect for how complicated an escrow officer or a closer's job is. But in this age of COVID, this pic seemed to be the most appropriate to me. We've got issues within the closing process of closing instructions, letters. A big issue, of course, is lenders want to put gap risk on you. They want you to certify that you're going to record in a certain time that you may not have control over. Similar to the age-old first lien demand, certify that this is a first lien. Again, you should be thinking in terms of when these are but-for claims. I don't want to turn title insurance liability into my liability. Alta just completed the uniform closing letter project. I think there's a lot of lessons and improvements that can come out of that. But in the meantime, be aware of objectionable provisions that may try to make you an insurer in certifying and allow them to make these tort suits instead of just simply having insurance, which has our terms, conditions, exclusions, and protections, limitations of liability. Payoff issues, and the big ones there are, we've seen a number of claims recently on paying off the CARES Act of the past. Anybody remember the Home Affordability Mortgage Program or the Home Affordability Refinance Programs, HAMP and HARP, from the last Great Recession? One of the things that happened with these is that they would do a forbearance. They'd split the mortgages into two, and you'd see the original mortgage, a modification, or what looked like a mortgage modification, but it was really a second mortgage in favor of HUD. When you have these payoffs with a HAMP or HARP modification, you have to go and get a payoff not just from the original lender, but from the HUD servicing contractor. Last time I checked, I think it was Novad Consulting. There are a lot of errors that happen here. The unsophisticated borrowers, this isn't necessarily a fraud. We have a terrible example where a title agent's own employee paid off their own mortgage. They didn't know that they still owed. They didn't understand the forbearance aspect, and that wasn't a forbearance and forgiveness. So we know that honest people are falling victim to this error. Also, as I promised Jeremy, the current forbearance issues. What we're seeing is that lenders are not talking. One side of the lender isn't talking to the other side. And when they send the estoppels, they're not calculating the fact that there's been a forbearance agreement and that certain recent payments have not been included. We've seen examples of where a lender sends after they send the estoppel, which is wrong. They receive the payoff, and only at the time they're booking the payoff do they come back and say, hey, wait, there was a forbearance and we need more money. And they're expecting the settlement agent to contribute that. A best practice everybody needs to have right now as a result of that on these forbearances is ask both the borrower and the lender, probably multiple times, including right before closing, have you entered into a forbearance agreement? Is this information correct? See if you can get a monthly statement and check to make sure the math looks about right to you in order to avoid this hassle that you're going to have. Document preparation, collection, review in the age of electronic closings. In fact, I even separate electronic closings themselves out as its own bullet point because it's such an issue. Whether you're dealing with e-signatures, e-recordings, e-notarizations, this is all new to everybody. There's no uniform laws despite ALTA's efforts at establishing some reliability on how this is going to work. We're all doing the best we can with a lack of a state law, federal law, or court case structure to backstop us. So we've got to be very careful about taking these risks. Work with your local experts, work with your underwriters. ALTA's doing a great job, not just with their advocacy, but with their education in this area. I would say the ALTA blog, Why Can't I Just Slap an E-Signature on a PDF Note, is required reading for everybody. Identification of suspicious documents and persons. This is, absolutely the last line of defense. How do we have this last opportunity to stop this fraud as it's happening? And do we still have experienced folks and appropriate procedures in place so that they can use their experience and wisdom even when working remotely and socially distancing to smell out with their gut and experience these suspicious issues? And recording, getting things recorded, getting them recorded timely, getting them into the right places, so crucial, something that's been overlooked. And in fact, we're going to talk about it because it is in my 5 key steps that we all need to be taking right now to counter these trends we just talked about. So the first key step, this is something we all know, you've got in our title business to be ready to recognize the fraud red flags. We've got to continue to understand the schemes, recognize that they're sophisticated and they have an insider's knowledge of our business. And the key to not falling for these is to be educated, aware, and vigilant. In these red flags I've identified, we've talked about the power of attorney and how that's a red flag. We haven't talked enough about mail away or remote online notarization as something that could be a particular concern. Well, it is. Do you have the necessary comfort that you are dealing with the proper party, that they have capacity, and that it's not a fraud? The fact that you're doing a mail away closing or a RON or RIN online doesn't change your ethical, professional, and potential liability obligations. Be mindful when you're given a questionable ID or the signatures don't match. More investigation is required. You've got to stop. Is the seller or borrower elderly or a business entity? Well, this could be a legitimate transaction, but it could easily be a fraudster that's created the entity or attempted to conceal their own identity or has manipulated the elderly. You've got to ask the questions. You've got to think in terms of these. If someone is telling you or you have reason to know that hiding information from lenders or the other parties is there, stop and consult legal advice and just stop. I know it's going to be hard to detect and recognize all of these different frauds, to see some forged documents, maybe one of the easier ones if you've been doing this long enough. The most important thing is to ask questions until you're satisfied. You've got to ask and investigate. Other red flags that we have to be aware of: the no consideration quitclaim deeds we've talked about. This may be in your recent chain of title, could be in the gap. We may not see it in the gap, or it could be offered to you at the closing table. This is often a situation that is indicative of identity theft. You've got to think about this, and oftentimes they're saying, hey, well, we'll have many more additional transactions for you if you throw this through, just grease the skids and make this happen. Great. How many bad deals do you really want? Be concerned about these red flags. That's the key. I want to mention unrecorded instruments. This is a big enough one that we've got to talk about. We're seeing more and more of this. The seller, as I talk about, will come to you and try to convince you to, don't worry about this, just record this quitclaim deed or this mortgage, and you can just record it together with the deed you prepare. Well, stop and slow down and recognize that there's significant risk here. It's not unusual for these instruments to be forged. It's not unusual for this to be a situation involving identity theft. You need to look, to the extent you can, at other documents signed by the grantor, compare the signatures, but the most prudent action is to contact the grantor to verify that that they actually signed and understand and intend to convey or mortgage the property. We need to eliminate the Abengoa title risk for you guys. Please evaluate the risks posed by the products and services that your company offers that are not filed title insurance products. If you provide any other products or ancillary services, are you protected? Have you negotiated the limits of the liability in advance, in writing? And is it clear to all the parties that's what's happening? You might decide now, hey, you know what? This property information report, this radius report, this accommodation recording, taking in this investor's escrow that's unrelated to a real estate transaction, it isn't worth it. Alta has done a good job in addressing as best they can a lot of this Abengoa risk. This was the reason for our 2016 commitment. We've revised the commitment so it's a clear offer to insure rather than a guarantee of the status of title or anything else. It's got the disclaimer, it's got the conditions that it's got to have a notice, the policy, all of the schedules, all this stuff. But one of the things I want you to be careful about is make sure you have the specific amount and the specific proposed insured in your commitment. As great as the form is, if you don't have the specific proposed insured, you don't have the specific proposed amount, what do you have there? Make sure you're availing yourselves of the protections that Alta is trying to give you. Wire fraud, we've got to prevent it. This is all about hard copy wire instructions, wet signature instructions delivered physically with regular mail. Always confirm the wire instructions with verified phone numbers, not phone numbers provided in any email ever. And advise your clients and your customers that wire instructions will not change and to verbally check with you. A big one also is your E&O and your cyber liability coverage. COVID-19 has implicated a lot of this. I know Alta's got other webinars that cover it. You've got to consult an insurance professional that is familiar with our business. Beware of social engineering exclusions, beware of laptop exclusions. You've got folks working from home right now. What are your first and third party coverages? Think about the laptop from one of your employees where one of their kids is playing video games on the work equipment. Does your E&O cover that situation? And finally, we've got to perform title updates and record. I mentioned I was going to talk about this because this is one that's kind of get back to the basics. What's old is new again. And because it's so basic, we might not fully appreciate how significant and how much so many claims that we're talking about in these trends can be avoided or mitigated by assigning sufficient staff and oversight so that you are doing pre-closing updates as close to closing as possible, you're recording the documents, and you're doing post-closing updates to see those post-closing matters. Recording problems, fraud, even the defalcations will likely be caught by this process, and we need to make sure that we're doing it. And with that, Jeremy, I'm done with my portion of the presentation. I know we've got quiz time for folks that want to stick around and learn some more.
Yeah, Len, wow, lots of fantastic info on the trends and all the red flags. So hopefully we'll keep that trend of claims paid going down over the past 6 or 7 years. So thank you for the, we got about 500 people still hanging out with us. So
wow.
Yeah, no, so wonderful. We got 4 questions. We won't spend too much time. I thought it'd be fun, you know, if we ask you guys some questions and see how well you were paying attention. So first question now on your screen, and then I'll launch the poll. You can vote here really quick. We got which of the following is not a requirement for a valid POA? I'll let you vote here real quick. Well, then it looks like most are, I think, coming to a conclusion that you're going to have. They got about 75% is the principal must know the agent. I'm going to go ahead and close it, share the results. So
they got it. Our audience is terrific. Of the various requirements for a valid power of attorney, 3 of these are absolutely valid and necessary requirements. One, the only one that's not, is that the principal doesn't have to know the agent. They have to properly identify them, but they don't have to know them. Good job.
Okay.
How about question 2?
Yeah. All right, let's launch that poll here. So whenever you encounter alternative lender financing, what should you do? Well, we got about half the people who voted so far. We've got a clear winner on this one.
I love it. Again, well done, everybody. When you have alternative lender financing, review with your senior underwriter, with your experts. Don't rely on the lender and what they're telling you, or trust the borrowers. Ensure you have a great notary. I almost wrote ensure you have a great day, because if you're not scrutinizing these alternative lender financing, you know, that might be the last great day you had. Question 3.
3, all right. Many title orders requested on a property could be an indication of
What say you? All right, I think people are pretty locked in at this point.
All right. We've got, again, our audience is spot on. You have many title orders requested on our property. This could be an indication of loan slamming. And by the way, I'll tell you that in certain situations where, there's an opportunity for a search provider to monitor different files, this is something that you're able to see. But in most jurisdictions, people are using independent abstractors, different disrupted searchers, and examiners, and so you won't know that there were many title orders requested. This is why it's so important to do the post-closing update, because when you do that post-closing update, you're going to see your insured mortgage. You're also going to see 2 or 3 or maybe as many as 6 is my record of how many I've seen, other mortgages that were recorded in the gap. You've got to contact claims immediately and get involved to try and unwind. Time is of the essence when that happens. Question 4.
That last one?
This is the last one.
Yeah. Known fraudster strategy to bypass questions related to the sufficiency of a probate order.
Looks like I finally got some folks to use different choices, and I'm glad that that was the case. The actual answer is it's a known fraudster strategy to use an independent escrow company in order to avoid questions related to the sufficiency of court orders, in this case, probate. The reason I included that, of course, I know everybody on this call and members of ALTA, you're involved and engaged in education, paying attention to these things, and this isn't something that would work with you. As an agency underwriter and someone that just loves our industry and our business, this upsets me. And the fact that this is a known fraudster strategy, I want to dedicate my time and every chance we get to have this never be a successful strategy of any fraudster involved. So with that, I think we're done.
Yeah. All right, Glenn. Hopefully everyone enjoyed the little interactivity here. Again, thanks everyone for joining us today. Great information on claims. I know we didn't hold time for Q&A. Len's email, let me hide this real quick, sorry. Len's email as well as mine is on the slide here, so please reach out with any questions, and Len would be more than happy to help you out. To wrap up, I need to once again thank Old Republic Title for sponsoring our compliance webinars. And looking ahead, we will be offering a webinar next week on how COVID-19 has affected the housing market. We have a senior economist from Realtor.com who is going to be giving all the numbers and providing some outlook for the rest of the year. And just I encourage you to go to the ALTA website, alta.org/webinars. You can go ahead and you can go there and check out other upcoming webinars and also access our archive of presentations. Also need to give a quick reminder to everyone to make sure your company is confirmed in the ALTA registry. Just being an ALTA member doesn't, or a policy forms license holder doesn't mean your company's automatically in the registry. So you can go to alta.org/registry for more information on that. Again, thank you, Len, for sharing your expertise with us today, and take care, everyone.
Thank you, everybody. Bye-bye.